This is the chapter summary for insurance overview. Commercial insurers, also known as private insurance companies, are in the business of selling insurance for a profit. Commercial insurers offer many lines of insurance. Some sell primary life insurance and annuities, while others sell accident and health insurance or property casualty insurance. An insurance company selling more than one line of insurance is known as a multi-line insurer. Commercial insurance is divided into two main groups: stocks and mutual issuers. Stock companies are organized and incorporated under state laws for the purpose of making profit for its stockholders/shareholders. Traditional insurers are called non-participating insurers because policyholders do not participate in receiving dividends or electing the board of directors unless they are also a stockholder of the company. When declared stock dividends are paid to stockholders in a stock company, the director and officers are responsible to the stockholders. Transforming of stock insurer in a mutual insurer termed mutualization, and the revision is termed demutualization. Dividends from a stock insurer subject to taxation because they are considered profit. Mutual companies are owned by their policyholders. Mutual insurers are known as participating insurers because policyholders participate in receiving dividends and electing the board of directors. When declared mutual companies, dividends are paid to the policyholders. Dividends from a mutual insurer are not subject to taxation because the dividends are considered to be a return of the premium. The only exception is that if the policy owner chooses to let the dividend sit and collect interest. In this case, only the accumulated interest would be taxable. If a company operates on both participating and non-participating insurer, they are known as mixed insurer. Dividends can never be guaranteed regardless of type of the company offering them. Strong assessment mutual companies are classified by the way the charge premium. A pure assessment mutual company operates based on lost share by group members. No premium is paid in advance. Instead, each member is associated an individual portion of loss that occurs. An advance premium assessment mutual changes a premium at the beginning of the policy period. If the original premiums exceed the operating expense and losses, the surplus is returned to the policyholder as dividends. However, if the premium are not enough to meet losses, additional assessments are levied against the members. Normally, The amount of assessments that may be levied is limited either by state law or simply as a provision in the insurers by law. Fraternal benefit societies are special types of mutual companies, non-profit, religious, ethnic, or charitable organizations that provide insurance solely to their members. Fraternals must be formed for reasons other than obtaining insurance. An example of fraternal society is Knights of Columbus. Risk retention group are mutual companies formed by a group of people in the same industry or profession. Example would be pharmacists, dentists, and engineers. Service providers offer benefits to subscribers in return for payments of premium. These services are packages in various plans, and those who purchase plans are known as subscribers. Example of service providers are health maintenance organizations, HMOs, and preferred provider organizations, PPO. Reciprocal insurers are unincorporated groups of individual members that provide insurance for other members through indemnity contracts. Each member acts as both insurer and insured and are managed by attorney in reinsurer. In the reinsurance agreement, the insurance company that transfers its loss to another insurer is called the primary insurer. Captive insurer is an insurer established and owned by the parent company to insure the parent company's loss exposure. Home service insurer, also known as industrial insurance, is sold by home service or debt life insurance companies. Face amounts are small, usually $1,000 to $2,000, and premiums are paid weekly. Government insurance. Federal and state governments are also insured. They provide social insurance programs to protect against universal risk by redistributing income to help people who cannot afford the cost of incurring such losses themselves. These programs have far-reached effects of millions of people. Depending on them, types of government insurance include Social Security, Old Age Survival Disability Insurance, OASDI, provides income benefits for elderly retirement survivors of those who died young child of deceased parent, and those qualifying for federal disability. Medicare, health benefits to care for elderly. Medicaid, health insurance to aid financially needy. SGLI and VGLI, serviceman or veterans group life insurance for active and retired members of the military. TRICARE, health insurance for members of the military and their family. Self-insurer, retained risk must have large number of similar risks and enough capital to pay claims. However, they may save money if the loss experience is lower than the expected costs. Self-insurers are not a method of transferring risk. Rather, self-insurers establish their own self-funding plan to cover potential loss. A self-funded plan is a plan in which an employer pays insurance benefits from a fund derived from the employer's current revenue. Lloyd's of London is not an insurance company. Members of the association form a syndicate underwriters and issue insurance-like coverage. This is a group of investors who share in unusual risk.